Welcome back. It's playing out according to script. We went down to around the 200 EMA. We saw a bit of a bounce of around 100 points odd. That's giving back a little bit. The crucial part is, can we hold on to the morning lows and see a bit of a fight back? Because there's crucial support at around that 17,360 odd from where we bounced earlier today. Well, let's focus on the space that's got the hardest knock this month. That's metal stocks. They have taken, a knock. They're down close to around 15% this month. For the year, they're down close to around 21%. And in spite of all this weakness, JPMorgan, they have an overweight rating on a couple of these stocks. Pinakin Parekh, Executive Director, Metals and Mining, Oil and Gas, as well as Cement at JPMorgan India, joins us on the show. Hi, Pinakin. You've been constant that you've been quite bullish on the metal space. And for some part of the last few months, from November lows, well, it worked out pretty well. We have been seeing weakness on these stocks. Do you believe that it's a good time to get into them? And if yes, what's your preference between ferrous and non-ferrous?
Yeah, good morning, Nigel. So essentially what has happened is that good news for the economy has been bad news for the markets. While the recent bounce in economic growth in US and Europe and improving data points in China are good for commodities per se, commodity equities have not reacted as positively. We continue to focus on the China reopening. Steel inventories declined for the first time last week in China. And this is particularly positive for the ferrous value chain as we enter the China 2 sessions and expect more positive news flow to come out and support the economy.
Okay, so more positive on ferrous versus non-ferrous. Preference for ferrous versus non-ferrous, right, Pinakin?
Break ho gaya hai. Yes, we would prefer ferrous over non-ferrous at this point of time, especially given the China rebound.
Pinakin, let's focus on pricing then here in India. Chinese prices have moved up dramatically, I think from around $510 to around $660 odd. So there's been a big increase. Indian prices have moved up, but not in the same manner. Do you believe there is a good chance that we see higher prices here in India? If yes, what is the price increases you're working with from year on? And also compare domestic prices with international imported prices.
Sure. So to start with, the domestic Indian steel prices never corrected as much as the Chinese HRC export prices did. What you had a situation in the second half of last year was that domestic Indian prices were at a premium to landed Chinese steel prices. So to that extent, the increase in domestic prices has been muted versus Chinese prices. That is simply the base. Domestic HRC prices are up roughly 11% from the lows of December. At this point of time, we estimate domestic HRC prices at around 60,000 rupees a ton. That will compare to landed steel prices from China at roughly 64,000 rupees a ton. So there is a good 5-7% gap over here, and we would expect domestic prices to increase. More important is to see what Chinese prices do, because at today's coking coal prices and iron ore prices, marginal mill in China on theoretical spot cost will be loss making. So we would expect more price hikes to happen in China, which should eventually flow through to the Indian steel markets.
Pinakin, hi, good morning. Let's come to the non-ferrous now. Hindalco, let's start there. I mean, on Friday it sold off, right? Big time, some 5% cut on Friday. Again, I mean, what's your thought process on Hindalco and the non-ferrous side?
So again, apologies, Prashant, we will not be able to speak on company-specific names. On non-ferrous, again, overall, the macro in China, if it continues to open up, it will be positive for non-ferrous as well, base metals as well. Inventories are low. Having said this, base metal prices tend to be more influenced by global investor flows versus non-ferrous versus ferrous commodity prices. So to that extent, any weakness in equity markets tend to flow through the base metal commodity prices. We have seen aluminum, zinc, copper prices sell off, even though on the ground inventories have been depleting. There have been production cuts in Yunnan in China because of drought. So you have a divergence between the fundamentals of the commodity and the prices of the commodity, more driven by investor fund flows, and that will influence stocks in the sector as well.
You do track the entire oil and gas space as well, CGD, downstream OMCs, ONGC. With Brent around these levels at $84 a barrel, what do you think the scenario would be for the oil and gas space? Which are the spaces to avoid? Which are the spaces you prefer under that umbrella?
Sure. So at this point of time, our house view is that oil prices rise from here. We are still looking for Brent to exit at $94 by the end of this year. That's more than 20% increase from here. Second quarter, we expect oil demand to surge globally, driven by China. 1.3 million barrels of demand increase as China reopens and travel picks up very sharply. So you should have stable to higher oil prices. At this point of time, within the broader complex, our view is still that downstream industries, basically refining, petrochem, where spreads should stay high, or spreads improve from decadal lows, as in petrochem's situation we saw in the December quarter. That is the space we would still want to be invested in within the oil and gas space. But clearly, we expect Brent prices to move higher from here.
All right, Pinakin, final question before we let you go. There's this NMDC steel plant, and it's getting a lot of interest from various steel players. The question is, how much will people bid for? I spoke to the management, and they said they have spent, before the steel plant gets commissioned, they'll spend 24,000 crores for a 3 million ton plant, which is 8,000 crores per million ton. What's your sense? How much would steel players be willing to pay for inorganic growth? Or how much are they paying currently on organic growth per million ton?
Sure, Nigel. So again, no company-specific comments over here. But what we would highlight is a couple of things. In India, the greenfield capex cost per ton of steel is roughly $1 billion for a million ton, which is basically get the land, set up the blast furnace, the coke oven, and the downstream capacities. Historically, we have seen multiple steel plants get auctioned under the NCLT process. So there is a valuation range which is available over there. And to buy any asset for a strategic buyer, it would come down to what is the time period they want to save in terms of setting up versus buying out. So again, difficult to answer what is the exact valuation one would look at, but clearly for a strategic buyer, the thought process is slightly different from, let's say, a minority buyer who's buying a share in a company.
All right. Pinakin, it's a pleasure. Thank you very much. Appreciate your comments and thoughts on the resources sector, as always, here on CNBC TV18. Thanks indeed.